Okay, welcome to those of you who have just joined us. We were just hanging out here for a minute to let people trickle in. My name is Alex. I'm going to be hosting today's webinar. If you can hear my voice and see my screen, you should see my browser and slide deck here. Then do me a favor and just type in an okay or a sounds good in the question field so that I know that you can hear me. And that's actually my little trick, just to make sure that you know where the question screen or question field is, because we will be using that today. So let's go ahead and get started. My name is Alex. I'm going to be hosting today's webinar, which is the Accountant Guide to Using Fund Accounting versus Standard Accounting Software. Okay. So again, my name is Alex. I work for a company called Aplos. We provide this type of software. Full disclosure, we're not going to be looking at Aplos today, but merely talking through kind of the subject of fund accounting versus standard accounting. But I've been with this company for 8 years now in a number of different roles, but primarily in this kind of capacity of the support team, the success team, the customer engagement kind of team, and then doing these webinars and things. So I am also newly licensed as a CPA, so I totally get the CPE journey that you guys are on at the moment. So hopefully this will be helpful and something worth the hours there. A couple of housekeeping things. If you have questions, we're going to be going through them as we go, but there will be a kind of a Q&A time at the end. So if you have any questions, then open up that question field in the GoToWebinar control panel, which you did to say okay or sounds good. And that's where you can type in your questions. Again, I'll go through them as we go. But then if I don't get to you either through the webinar or at the end, just continue to post those questions and I'll do my best to follow up as quickly as possible after the webinar. Also, we will be sending a copy of the presentation as well as a recording of this event to you after the fact. Now, full disclosure, we have had some technical difficulties in the recording aspect here of actually like saving the recording of these things, but we're going to do our best. If it's not there, then we can at least get you the slide deck. And yeah. And then for the CPE certificate requirements, if you are a CPA here to try to get a point or two towards your CPE, then a couple of requirements. You have to answer at least 4 out of the 5 poll questions that we're going to do during the webinar. You'll have to be present for at least 50 minutes of the presentation. We're going to be here for about an hour, so 11 o'clock Pacific time is when we'll end. And then there's an evaluation survey that we will send after the webinar, so you'll have to complete that as well. Once all of those things are taken care of, then we will send you the credit. So today again, the subject is the Accountant Guide to Using Fund Accounting versus Standard Accounting Software. So a specialized financial platform for nonprofits and churches can be a dynamic tool for your firm when handling your nonprofit clients' bookkeeping. This webinar is going to serve as an in-depth guide on the benefits of why you should be using fund accounting to manage your nonprofit clients' bookkeeping, with examples of ways to save time on tedious tasks using the right software. The session is ideal for professional accountants and bookkeepers and have at least a basic understanding of fund accounting principles in bookkeeping tasks. So today, what we're going to cover is first the basic differences between standard and fund accounting. If you're anything like me, I might be a little unique here, but I learned fund accounting first. So I didn't really know anything about accounting overall. I thought debit and credit meant debit and credit card at first. So when I learned accounting, I learned fund accounting. So it's kind of second nature to me. But when I started getting more into the nuances of the difference between the two, I realized that, especially if you're going the CPA or the accountant major track, fund accounting is like one class or one type of subject that you take in a myriad of other things. And so it can kind of get lost in the details. There's some government reporting and that it's for governments and nonprofits and religious and whatever, but really sinking into the nuances between the two is not something that I encountered on my journey in my CPA licensure. So today we're going to look at those in a little bit more depth and a little bit more, in my opinion, practicality. So again, the differences between standard and fund accounting. We're also going to look at the pain points of using standard accounting software for nonprofits. If you are a CPA or an accountant of some sort and have a nonprofit client, I'm sure that you've encountered some of the stuff that we're going to cover there in number 2. So we'll point those out and then talk about those in more detail. And then the third is going to be the peripheral goals and benefits of using tailored nonprofit software. So in addition to just fund accounting, so if we can straighten up the accounting, that's a great goal in and of itself. But then what are the peripheral goals and benefits of using a nonprofit specific software rather than a kind of a piecemeal or a for-profit functionality for software? Okay, so let's take poll number 1. So what I'm going to do is I'm going to launch this. You should get a little pop-up on your screen, and then I'm going to give you about a minute or so to answer this, and then we'll go back. So first question, do you currently serve nonprofit or church clients? Yes or no? Well, and since this is an easy question, it looks like everybody has almost voted. I'll wait till we get to 90%. It's 88% voted. So again, if you want the credit, you have to answer 4 out of the 5 questions. 100% voted. Great. So do you currently serve nonprofit clients? 67% yes, 33% no. Thank you. Okie dokie. So back to the presentation. So let's get into it. Let's talk about standard accounting versus fund accounting. The basic differences between standard and fund accounting, and this is going to maybe use some language that is somewhat familiar, but in the fund accounting world, so fund accounting again is used for nonprofits, government agencies, schools, which a lot of the times are government funded, and then religious institutions. So really mainly entities that are using other people's money is kind of what the bottom line is there. I mean, you can argue that businesses use other people's money through debt financing and stuff, but I mean, if they get a grant or a donation or some sort of financial sponsorship of some kind, typically those types of organizations will end up falling within the category of using fund accounting versus standard accounting. So some nuances of fund accounting is each fund is a self-balancing set of accounts. And we're going to take a look at an example of that here in just a minute. But what that means is basically each fund that you're keeping track of has its own chart of accounts, its own assets, its own liabilities, equity, income, and expense. When creating a chart of accounts for a fund, each fund is set up as an equity account. So typically in a nonprofit software, you don't have a difference between retained earnings, net income, or owner's equity. You have simply a fund balance for each fund that you have. Again, we're going to take a look at examples. So each fund is equity, no retained earnings versus net income. And what this kind of implies is that your chart of accounts, rather than being lengthy and linear, it's more dimensional. So you can potentially, when creating a chart of accounts for a fund accounting system, you don't necessarily have to add a ton of the detail in a vertical manner. You don't have to add more income and expense accounts or things like that to track the level of detail that you need. Instead, what you're doing is adding dimension. Okay. So here would be an example of a standard chart of accounts, very linear. You have assets, liabilities, equity, income, expense. You have what you own, you have what you owe. You've got the kind of the net worth or the value there of equity, income, and expense for your income statement. So where this differs in fund accounting is, again, each fund has its own chart of accounts. So if you're thinking of, maybe I should take a quick breather here to just explain kind of what a fund is. A fund would be something that has its own compounding balance and something that needs to be set aside from anything else. So in the terms of maybe a church, churches typically have a general fund, which is used for normal expenses. It's where most income comes in. But then they also might want to have a missions fund, or they might want to have a building fund, or a youth fund, or an outreach fund. In a nonprofit, I was on the board for a human trafficking organization, anti-human trafficking, just to clarify, organization. And they had a fund for kind of the general stuff, but then there was an outreach fund. So kind of, money that they wanted to allocate that was different than the kind of normal stuff coming in. And they wanted to kind of, take a chunk out there and hold it separately and say, this is the fund that will get its own income, its own expenses, its own balance for this separate thing. The IRS, or not IRS, but the kind of the governing agencies also describe the kind of 2 buckets of funds, either the donor restricted funds or non-donor restricted funds. So funds can be any reason why, if someone gives you money and says, I want you to spend this for this specific purpose, and you say, great, thank you for the money, then now you have an obligation to set that money aside and spend it for that particular purpose. So that's the example of a donor. It could be a grant, could be anything really. So a fund is its own kind of separate balance set aside from everything else, but again, part of the larger total of your organization still. So for each one of these funds, it's going to have its own chart of accounts. So each fund has its own assets, its own liabilities, its own equity, income, and expense. So for kind of the remainder of most of our examples here, I'm going to use 3 different funds as the example: a general fund, a grant fund, and an outreach fund. Each one of these can be kind of designated as a different type of fund. So a general fund would be typically referred to as like an unrestricted fund. So again, probably where most of your revenue comes in and most of your expenses go out. Your grant fund would be an example of you receiving money from an outside organization that now needs to be tracked uniquely and kept up with and reported on to make sure that you're spending in line with why they gave you the money in the first place. And then an outreach fund doesn't necessarily fall into the balance of a donor restricted or non-donor restricted. It's still restricted, but it might be like a self-restricted. It might be that your board on the nonprofit said, we're gonna kind of separately piecemeal our money or our income out into this other thing, of which we'll call the outreach fund. So again, kind of unrestricted, restricted by an outside agency, and then internally restricted for outreach fund. But each one of these funds would be a fund that you want to keep track of. Again, its own assets, its own liabilities, in equity, income, and expense. So let's do poll number 2 real quick. Question is, what software do you typically recommend for your nonprofit clients to manage their bookkeeping? QuickBooks, Excel, Sage, Xero, or I don't recommend a specific software. All right, 79% have voted. I'll give it another 20 seconds or so. Remember that in order to get the CPE credit, you'll have to participate in at least 4 of the 5 polls. So don't check out just yet. 3, 2, and 1. All right. 54% said QuickBooks, 8% Excel, 38% I don't recommend a specific software. Great. All righty. So that was each fund as a self-balancing set of accounts. So now let's take a look at each fund as equity. So if each fund has its own chart of accounts, then when you're putting them all together into one comprehensive chart of accounts, if each fund is its own equity, then you don't typically have the typical difference between retained earnings versus net income. In most fund accounting systems that I've seen, well, all of them that I've seen, including ours, when you have a fund, you typically don't distinguish between what portion of the equity is retained earnings versus net income. Reason being is with every transaction you enter into a fund accounting software, you're picking both an account and a fund. So you're saying, for instance, here is my income, right? So my 4,000 contributions income account. And I'm going to credit that for $100, and that's going to debit my cash account for $100 as well. So you're picking those accounts just like you would any other accounting transaction. But with a fund accounting system, what you're doing is you're picking the account and you're picking what fund that it impacts. So when you entered that income transaction, you're saying, I am receiving income for my general fund and I'm getting cash for my general fund. So now what you've done is you've just said, I am now putting money into the cash balance for that fund and I'm increasing the income statement or the profit and loss transaction or report for that fund. So now that fund's income statement and balance sheet are now up to date. So with that kind of up-to-date calculation all the time, there's really kind of no difference between what would be kind of a prior year's earnings or withheld versus a net income. And especially because there's not really like room for it in the chart of accounts either. So what I've typically seen is each equity account is going to be its fund balance. So back to my example here, we would have an equity account for general fund balance, an equity account for grant fund balance, and an equity account for outreach fund balance. So then on your balance sheet, in your equity section, instead of seeing how much of the organization is retained earnings, net income, or owner's equity, you would simply see, here is my general, grant, and outreach fund balance. Just like that. So this is what the equity section would look like on your balance sheet, which we'll take a look at an example here in a minute of what the equity section would look like in fund accounting. And then the difference, the last difference here is it's dimensional rather than linear. So when you're talking about your chart of accounts, what a lot of people will do is they'll build detail into the linear or the vertical chart of accounts. So you need more detail, add more accounts. You want to track something unique in the income and the expense, add more accounts. But what fund accounting allows you to do is add dimension. like this into your chart of accounts so that you don't necessarily have to create more accounts to capture the same level of detail. So let's go through an example. So back to this one. In the standard chart of accounts, you would have, the top three lines here: asset, liability, and equity. That's your balance sheet. So you would see, what's my asset totals? 10,000. My liability total is 3. So then my equity is 7. Assets minus liabilities equals equity. For my income statement, I received 20,000 and I've spent 18. So I would have a net income of 2,000. But again, back to the example I used a minute ago, when you're recording transactions in a fund accounting software, you're not only picking what income, asset, liability, expense, equity account, whatever is involved in the transaction, you're also picking what fund it impacts. So if you were to enter, like that transaction I said, $100 worth of income, and it's increasing the asset, and you're picking the general fund, that now impacted the general fund financials. So in a fund accounting system, what you have here is something like this, to where the totals are the same. So 10,000, 3,000, 7, 20, and 18. The totals there on the very right are the exact same, but because you've been entering the fund along with the accounts with every transaction, it should be able to populate a report that is like this, to where each fund now has its own assets, liabilities, equity, income, and expense balance, which means you can run an income statement, a transaction list, a statement of cash flows, a trial balance, and a balance sheet, all by fund or for the cumulative total. So in our system, we have similar reports to this, to where on the very right, you have a total amount column, which shows the sum of everything. So that's kind of the total snapshot. But then each column in the middle is one of those funds. So I can see, in my asset account, I have $10,000. But without fund accounting, I might not know how much of that is my grant, which again is money that's been given to me to steward in a certain way. And so if I spend more than that, now I'm outside of the realm of what's allowed for that grant. Like, how would I know how much money is there if I'm not using fund accounting? So that's where something like this comes in handy. I can quickly look at, I have 10,000 in the bank, but I have a $4,000 purchase that I want to make for my grant fund. Well, I only have $3,000 worth of income, $3,000 worth of cash available for the grant fund. So that would steer my, decisions. Same with the general fund. I might think that, I have $10,000 in the bank to pay payroll, and that's $9,000. But then I'm looking at it, the general fund only has 5. So if I'm now using more money than what's in the fund available, now I have, some questions, or at least, something to look into. And this spans the gamut of your entire chart of accounts. So again, you wouldn't necessarily just see income and expense. You should be able to see asset balances, liability balances, and equity, income, and expense for each fund, as well as the total in a fund accounting system. Here's an example, kind of similar. This is an Apples report here, to where, again, at the very right, we have the amount. So here's the total. And then from left to right, you have the different columns for the funds. So here is a balance sheet by fund from Apples, to where we have the asset accounts all the way down to total assets. Then if you follow that all the way to the right, that's the total. Then you have the total liabilities. And then you have the equity section there that shows General Missions Building Fund, each with their own equity balance. This would be an example of the income statement. Again, same 3 funds. The amount column on the right is the cumulative total for the period that you're looking at. So year to date as of June 13th. Each column has its own income, its own expense. So if you're looking at a total income statement and you're thinking, we've had 206,000, without fund accounting, it's going to be hard to track how much of that was general missions or building or whatever funds that you have in play. And then down at the bottom, you have your net income per fund. Now, something that we have, I'm not sure if other fund accounting systems have this, but you should be able to get to a similar summary, is this bottom portion here, where we pull in what was the beginning fund balance, what are the other fund balance movements, what's the net income, and then what is now the ending fund balance for the fund column that you're looking at. So the date range here is year to date, so January 1st. So what we're doing is we pull the figure from the balance sheet and say, okay, as of 12/31, the end of the period right before this report that you're looking at, what was the beginning fund balance? So let's just look at general fund here. So the general fund balance was $115,567.20. You then had other fund balance movements. Now, this one is a little bit unique, to where what this means is this is something that has impacted your fund balance that is not captured on the income statement. So the income statement captures income and expense. What this would not track is a, say, payment of a liability that was on the fund, or a receipt of a receivable, or a depreciation, or depreciation would be on there. Fund transfers. So if I wanted to say that I wanted to move money from one fund to the other, that's not income or expense, because it's not new money. You already have that money. You're just kind of allocating it differently. So those kinds of fund transfers, basically that row there, what that's capturing is, again, anything that has impacted the fund balance outside of your net income figures. So, but that's factoring into what your ending fund balance is. So we have that there. Then you have your net income from above. So, 115 and change minus 500 plus 201,000 equals 316,792.20. That ending fund balance would now correlate with the balance sheet by fund as of 6/13. Again, kind of tying your reports together. So this is, between these two reports, you now have an income statement by fund and cumulative, so total, to show, what's the total kind of health, but then what is it per fund. I've also got a summary of what other things have happened to your fund during the same time frame. And then paired with now your balance sheet, you can now provide reports to whoever, whether it's your congregation or granting agency or the government, or just your board, or whoever you need to, or the bank or something like that, whoever you need to pull reports for. You can show them, here is now my total financial snapshot for my organization, as well as how it's divvied out by fund across the board. Okay. Let's do poll number 3. What is your experience level with Excel? Advanced, good, moderate, novice? What's Excel? And while you're answering that, someone asked, are the slides available? Yes, we will make these slides available to you after the webinar, as well as the recording of today's session, pending no technical difficulties and actually saving the recording. So, yeah. And these questions on how advanced are you in Excel, before I met somebody that was advanced in Excel, I would have rated myself as good. But then I met someone that was truly advanced in Excel, and I knocked myself down to novice again. But fortunately, I've climbed my way back. So I don't know what feature specifically would separate the difference between the two. But all right, 3, 2, and 1. All right, 46% said advanced, 8% good, 31% moderate, 8 novice, and 8 what's Excel. All right. Okay, so that was the section of the kind of the basic differences between standard and fund accounting. So now let's take a look at what are the pain points of using standard accounting software for nonprofits. 3 kind of things we're going to talk about here. One is using sub-accounts to track unique balances. The next would be using classes or tags as fund activity, and then equity adjustments. So first, let's talk about sub-accounts to track unique balances. Not to pick on any software, but QuickBooks is synonymous with accounting software. So I think all of us are relatively familiar with what QuickBooks is. And honestly, they are unrivaled, in my opinion, as far as business accounting goes. But they don't do fund accounting, and it's just a fact. Nothing against them. It's a different brand of accounting. So to compensate for that, some people have come up with workarounds to try to make a for-profit, standard accounting software work for a nonprofit. One of these is setting up sub-accounts to now track the detail of how much is allocated per fund. So for instance, checking. Back to this example, I have a checking account. There's $270,000 in it. And instead of having sub-accounts using a fund accounting system, I can quickly get to what's the total and then what's the total by fund. But without a fund accounting system, what you're left with is having to set up now sub-accounts to kind of carry those unique balances. So again, for instance, checking. So let's say my checking account has the $100,000 in it, and I want to track how much of that checking account is general grant outreach, because I need to make sure that that money is separate. So I got a grant. Someone gave me money for something very specific. So if I don't spend the money in that way, how can I make sure that I'm in line with the grant requirements, right? So what I do is I set up sub accounts. The problem with this is you're going to need to do it for every account that needs a difference between general grant and outreach. So if you have money in the checking account and you have money in the savings account, both of which might be general grant or outreach money, you now need to have sub accounts set up for each asset in order to track, what is my general checking versus general savings, and so on and so forth. Some downsides here is it requires sub accounts again for anything that needs to be split by fund, and that's just one asset example. This bleeds its way into everything. So if you need liabilities, if you need to track how much of your accounts payable is split by fund, which is, if let's say the grant was to do some sort of building improvement type thing. Now you have contractors, you have schedules that you're trying to keep up with on making payments, and you have float. You accrue something in one period, you might not want to pay it for 60 days to make the cash flow. That is now tracking a whole comprehensive asset and liability balance by fund. And so if you can't split AP by fund balance, it's going to be really difficult to figure out how much you owe in your general fund and your grant fund. So to do that, you could set up sub accounts. But again, now any account that needs the fund detail, you're setting up sub accounts for each one of your funds that you need the detail for. This is only 3. If you have 5, 10, 15, some of our clients have over 20 or 30 funds they're keeping track of. That is a lot of sub accounts. It also makes bank reconciliations the worst. It makes them extremely difficult. The only way to really do that comprehensively would be to find a software that allows you to reconcile multiple accounts into one reconciliation. I don't know if that's possible anywhere because it's kind of a weird situation. So if not, then what you're left with is you receive one bank statement for your checking account, but now you need to go through and parse out what was my beginning bank balance for general grant and outreach, what has now been the activity according to my bank statement for general grant and outreach, and then what would be my ending balance, all summing up to what the true ending bank balance is. So it makes bank reconciliations just a nightmare. It might also lead to, because of that, it might lead you to actually creating separate bank accounts to track the different money balances. So with that example, you're like, oh my gosh, that is the worst. We don't want to do this. Why don't we just set up 3 different bank accounts, one for general, one for grant, one for outreach? You can do that. It's a kind of an operational hassle because now you have 3 bank accounts. And when you post a deposit, now you need to be very specific on what money goes into what bank and then do transfers back and forth for different things. So it's kind of a operational workaround, not necessarily an accounting one. It's just something you would implement to actually physically separate the money. Again, with fund accounting, you wouldn't necessarily need to do that because you can have one bank account, but then just track what are the unique balances per fund in that one bank account. We get a lot of customers that come to us and have multiple bank accounts set up just for that specific purpose. Any new unique fund balance that they need to keep track of, they go open up another bank account. Which again there's nothing like technically wrong with it. It's just a lot of work to keep up with, and it's not necessary. So now that the caveat to that is there might be requirements from the grant or from the bank if you are lending. There might be reasons why you have cash balances separated to keep minimum balances or certain reserves. That is completely different in my opinion. That is required versus something that you're doing in order to track a level of detail that you need, right? The other problem here is it only adds to the linear chart of accounts instead of adding dimensions. So remember, in standard accounting, you have your list, asset, liability, equity, income, expense, linear. And if you want to build more detail, you have to build detail into the chart of accounts. So you end up with these chart of accounts lists that are hundreds of accounts long, depending on what you do, hundreds, to capture that level of detail. And it's just not always necessary because if you have an asset account and there's 20 funds, instead of having an asset account and 20 sub accounts, you could have an asset account and then 20 columns The columns are the dimension that you're looking for. That's what's capturing the detail, and that's what's going to give you the reporting that you need, not the linear list. So again, it's not necessarily solving the problem. It's kind of it's a workaround, and it can get by if you don't have that many funds or that complex of stuff happening. But at a certain point, it breaks, and it's hard to deal with. The other one here is using classes or tags. We call them tags. QuickBooks calls them classes. I'm sure all software has some name for them, but the general usage is the same. What it is it's a parameter. It's a something that you're putting onto the transaction in addition to the account to track profit and loss activity. The problem is it's limited to profit and loss. These types of features are only applicable to the income statement and a transaction list, but anything related to income and expense, now you can capture that level of detail. So you might think, okay, well, we'll just set up a general and a grant and an outreach tag or a class or a whatever. And that will give us now the level of detail, which again, it gets you halfway there. So it gets you to the income statement. So you can run something like this. So you can see here are my income accounts, my expense accounts, and this is just a super basic, example chart of accounts, nothing special going on here. And then my tags, in Applos or classes would be able to be either filtered by, or you can do it one at a time, or by pages, or by column. I like the column view because it's more, Excel-y. It's gridded out. So I have a class or something for golf fundraiser, my Giving Tuesday, and Women's Tea. Those might be things that I want, unique balances for. That those columns could just as easily be general fund, grant fund, and outreach fund. And then I have my total on the right. So it looks very similar to the income statement I showed you earlier, which is split out by fund. Again, it's only halfway there. What this is giving you is it's giving you an income statement or a profit and loss, and then by result, a transaction list by class or tag for that thing. What it doesn't give you is any sort of balance sheet. So what you'd still have to do is, well, here we go. So it's only applicable to income and expense accounts. It doesn't tie to a specific asset or liability. So if I said that my grant income had $100,000 worth of net income, where is it? Is that in your checking account? Is that your savings? Is that in a building? Is that a vehicle? Is where is that money? And without being able to produce some sort of balance sheet by fund, it's extremely hard to answer that question. And then this kind of bleeds into what our third one here is it would, using the net income figure that you can get from that, it would also now require equity adjustments to keep your funds straight. So that's the last point here is equity adjustments. So what these equity adjustments are is, let's say that you're using both of the prior two things that we talked about. You've got sub-accounts set up in your assets liabilities for fund balances. And now you have your income statement by class or tag to give you activity. What you would do is you'd say, okay, well, I want to now take my net income figure for the class or tag, and now I need to update my balance sheet. So now I need to figure out, okay, if I have a sub-account for the grant fund in checking, and I have a net income of $10,000 for that fund, I now need to make sure that that $10,000 was actually tracked activity-wise in that particular asset account. So let's double check there. And then in order for me to get a balance sheet by fund, now I need to factor in, do I have any liabilities against that grant? Well, maybe. So let's make sure that those sub-accounts are created and those balances are correct and all the accrual, whatever is all tied in there. And then for the equity, now I would need to do an equity adjustment to move it from whatever, net income or whatever the equity account is that it would be in order to over to some sort of specific fund equity. So again, it's possible. What I found is that volume breaks everything. If something's not designed right in the first place and you're doing some workarounds or some patchwork to make it work, what will kill it is volume. So if you only have two funds and there's not a lot of complexity, it doesn't matter. You could use Excel for that and be just fine. If you have a lot of funds, or if you're very more complicated, or you're doing a lot of accrual adjustments and things like that, it's going to break. So what you'd have to do to produce the same types of reports as we had earlier, which are these guys, like an income statement and a balance sheet by fund, by column, you would have to set up a lot of sub-accounts. You'd have to reconcile those sub-accounts either individually or somehow cumulatively to make sure that the balances are right, and then hide them on the report. So now all you see is just checking. And then you'd have to make manual adjustments factored in on the net income per class or tag in order to move the equity around and make sure that the liabilities all tie in, and then make sure that the assets equal the liabilities plus the equity. So again, it's possible, but I'm sure that those I's are already crossed. And so that is kind of the pain point here. So again, the requirements to make standard accounting software work for a nonprofit chart of accounts. You would have to have asset sub-accounts per fund. You'd have to have liability sub-accounts per fund. You would need an equity account per fund. You would need classes or tags per fund. You would need to be able to do consolidated bank reconciliations, hopefully. Otherwise, bank reconciliations parsed out by fund somehow from the bank statement. You'd have to do equity adjustments using income and expense that balance to the corresponding assets and liabilities. You'd have to potentially separate income and expense accounts per fund. And then you would probably need some sort of CPA or accounting professional involvement to make sure that you're staying within GAAP or grant, just governing authority restrictions alone, let alone does this even make sense in an accounting system type stuff. And then I put in coffee, lots of coffee. Pull number 4. Poll number 4, for those of you staying on top of it, this is the last one that you would need to complete for the CPE requirements. What areas do you see your nonprofit and church clients needing the most assistance in for financial health? Reporting, weekly and monthly maintenance, which to me more means upkeep. So just kind of staying alive with entries and just upkeep, budgeting, and then adherence to GAAP or other governing bodies. And if there's multiple, I don't know if you can click more than one. I think you can just pick one, but just pick whichever one's the loudest in your opinion. Okay, 3, 2, and 1. 38% said reporting. It's always the bigger one, in my opinion. 15% said weekly and monthly maintenance. 23% budgeting. 23% said adherence to GAAP or other governing bodies. Perfect. Okay, so we talked about what the basic differences between standard and fund accounting are. We've now talked about kind of the pain points of using a for-profit non-fund accounting software for a nonprofit. So now let's look at what are some peripheral goals and benefits to using tailored nonprofit software. And this is getting out of necessarily fund accounting. So this is other stuff that could be helpful for these organizations and then you as professional accountants or CPAs helping them. One is combining the front and back offices. So back office meaning operational stuff, accounting, salary, payroll, scheduling, that kind of stuff. Front office is more of the engagement. So this is them engaging with their constituents, their congregation, their whatever, their body of people that they want to do some outreach and focus on, whatever their purpose is. So the front would be stuff like donor-related things. So I want to track, who donated last year but not this year, who donated some year but not this year, who's never donated before, who's new, who attended an event that I haven't had coffee with yet. What's my hit list as a fundraiser, as a executive director, as just a staff person for a nonprofit? Who do I engage with in order to progress our mission and or get some more donations, because that's kind of the bread and butter, right? So combining the front and back offices with a tailored nonprofit software, you would be able to do hopefully the gamut. So you would be able to say, here's my website. Here's my website designed. On my website is a donation form and some sort of, sign up form for like events and stuff that then pushes into my account or my software to tell me who registered, are they a donor, when was the last time I had coffee with them, and then those donations would then wrap into the accounting and post it as a deposit to keep my financial statements up to date so that I can reconcile and provide reports and do budgeting and forecast and whatever. Like all of that kind of nonprofit operational tasks would hopefully be combined in some sort of tailored nonprofit software. If not, and most of the time it's not, you would have some sort of now API or some sort of integration connection between those two, or just use completely different systems and figure it out. That's usually the most often. But hopefully there would be some sort of combination there. You would also have the ability to reduce the need for cleanup prior to an audit or CPA review. Now, I realize that I'm talking to a room of people that get paid to clean this kind of stuff up, so totally get it. This is not to kind of naysay the involvement of a CPA or accounting professional, because I think that we are needed for all of that to make sure that you're in line with stuff and to provide confidence and what have you. But most in the demographic of people that we work with, church and nonprofits, these are not typically business-minded people. They can do it, and there might be somebody on staff that can, or a board member that kind of keeps them in line. But for the most part, these are people with purposes, with missions, with ideas and goals, and a big hill that they want to climb. And accounting is just one of those things that they need to do in order to just not belly flop. So in order to kind of equip them, if you will, with the tools that they need to stay compliant, to stay up to date, to make good financial decisions, to manage their staff, to really steward their money and their organization well, they would benefit from having a system that's been designed to allow them to do that, right? Because otherwise what they're having to learn is they'd have to learn QuickBooks, and they'd have to use PayPal, and they'd have to learn Fellowship One, and they have to learn all these separate systems and then somehow tie them all together. I mean, you need a full-time staff person just to manage your systems, So the benefit here is if you had it, you should be able to reduce the need for cleanup prior to audit or CPA review. Again, not to negate the involvement at all, but just hopefully you'll be able to just kind of keep up with it, right? Which kind of leads into the third point there, accessibility and usability for day-to-day staff. I'm sure as CPAs, especially ones that charge hourly, the request to just, I don't know, I throw my hands up, come fix things for me it's always a little bit frustrating, but at the same time, it means hours and billable hours. So who cares, right? But it's also nice to be on the other side to say, here's this organization that's come to me for a review or consolidation or compilation or some sort of audit or just whatever. They come to you and they say, here you go. Here's our financials. And you look at them and you say, oh, great. Thanks. Cut you down your need. There's very few questions you need to ask. It's not completely ripping out the carpet and having to redo everything. They have now been able to use the system, enter good data, pull good reports, give you good information so that it decreases the need for you to basically go work for them for a couple of weeks and clean everything up, right? So those are some peripheral goals and benefits to using the Taylor nonprofit software. I should have been clicking through the slides that whole time. So just as a quick hit list here. So combining the front and back offices: fundraising, donor management, groups and teams, website design and maintenance, event management, payroll, 1099s, and 990 prep and submission on top of fund accounting. Reduction in the need of cleanup prior to audit or CPA review. No sub-accounts for different funds. So you wouldn't have to perform bank recs for split accounts and things. You wouldn't have you would have a shortened or a dimensional chart of accounts instead of a long linear one. So if they say, here's my income statement and it's 8 pages, oh my goodness, that it wouldn't necessarily be the case. You would also have the benefit of auto calculating the fund balances per transaction recorded. So there would not be adjusting entries or any sort of post equity cleanup that would need to happen. You wouldn't necessarily have any closing entries either. This one is more of, I don't know how unique we are in this, but with Aplos, we don't require any sort of closing entries to roll net income into equity. Reason being is we know when your fiscal year is, and then so we know when your fiscal year ends. So as soon as your fiscal year ends, then those income accounts and expense accounts need to now report as zero for the next period. So really all it is, it's date parameters. It's just knowing that as of a certain date, income and expenses are rolled off. If you want to go back to that date, you certainly can. But and then the balance sheet, again, with every transaction is kept up to date. So there are no closing entries with Aplos. And then you wouldn't need any equity adjustments and manual balancing calculations. And then lastly, the accessibility, usability for day-to-day staff. You would reduce the need for a CPA or accounting professional to be involved. You would simplify your bank reconciliations. Again, the other benefit is you have a shortened and dimensional chart of accounts as opposed to a long and linear one, vertical one. You would have ease of use by the end user. So if you hired somebody, you wouldn't need to spend 90 days, teaching them multiple systems. You say, here's kind of the gist of things, enter this there. It's somewhat easier to use if it's been tailored for the specific purpose. and then the consolidation of multiple front and back office features. Let's do poll number 5. Are you interested in learning more about applets for your nonprofit clients? I will not take it personally. Answer however you feel. We're at 85% voted. We were at 90 something percent for the other ones, so maybe there's somebody that is idle. But again, this is the last poll, so if you missed one, make sure to answer this one so that we can get you your CPE credit. Okay, 3, 2, 1. 50-50. All righty. And just to further clarify this, by answering in the affirmative, yes, does not mean that we are going to now barrage you with lots of marketing materials and things, because everyone hates that. So it was mainly just for our collection, just to gauge. So what we did today is a lot and arguably too much for 60 minutes. This is a big subject. Again, like I said at the start, fund accounting is one of those things that you typically take one class on, some sort of government, accounting and reporting type class, and you just get a fire hose to the face of different types of fund reports and different types of governmental reports, and that barely ever trickles down into now day-to-day application and use for the little guys. Government reporting is one thing, but that is extremely nuanced. I would assume that the number of people involved in government accounting is small. And there are something like 1.2 million nonprofits in the US right now, and that's not including churches. So probably upwards of 2 million entities that use fund accounting, and my guess, have never been trained in anything remotely close to it. So the subject of fund accounting versus standard accounting is a big one, especially for CPAs and accounting professionals that have been using standard accounting for their entire careers. The concept of using a different, functionally different accounting type software is a little bit weird. But I promise you, it is not that much different. You still use the same chart of accounts. Debits still equal credits. All it really is the inclusion of a level of detail per transaction for all account types of picking what fund that you're impacting. Really, that's what it boils down to, because then what that does is, again, allows you to run specific reports for assets, liabilities, equity, income, and expense, so that you don't have to do any silly workarounds. You don't have to do anything special. It's just there and kept up with, assuming you've kept up with the transactions, but that's beside the point. As long as you keep up with the transactions, you should be able to get to fund accounting reports versus standard. So we covered the basic differences between the two. Again, kind of dimensional rather than linear. Each fund has its own equity. Each fund has its own self-balancing set of accounts. The pain points of using standard accounting software for nonprofits, so sub-accounts, classes or tags are one of those other kind of items that you can throw onto there that would capture a certain level of detail, income and expense related, but wouldn't necessarily bleed into the balance sheet accounts. And then equity adjustments. So if you're using the sub-account nature for the balance sheet accounts and the classes or tags for the income statement, then you can kind of somewhat, maybe, potentially, hopefully, possibly merge the two and do some equity adjustments to now get your way into, balance sheet by fund, but it would be difficult and fun to keep up with. And then peripheral bills is it decreases the need for some more technical expertise. It would decrease the need for peripheral systems, so you can hopefully have one kind of system that kind of combines the front and back office. And then just for day-to-day use, it would be something that is tailored to the nonprofit. So using something that has been been designed rather for that space and demographic would be better than the alternative. Much like running a business using a nonprofit software would be kind of strange because you don't produce the same types of reports. So you want to use something that has been made for the purpose. Questions. So we have 8 minutes here to answer some questions. So do me a favor and go ahead and post some questions there. Back to the housekeeping thing, I've seen those questions here a couple times. Yes, this is being recorded. We have, full disclosure, had some technical difficulties with saving the recordings with this program, but if it works, then we'll have it and we'll send it to you. At the very least, what we'll do is send you the slide deck, so all of this stuff here, and then some contact information for us as well. So if you have any questions after the fact, let us know, and we'd be happy to answer. All right, so first question here is, how do you account for advanced funding from a government grant? In other words, unearned income for the balance sheet. That one would, let's see, yeah, okay. So two questions from you, Michael. So the first one there, so unearned income for the balance sheet. What that would really be a matter of is the unearned income would be the liability, right? So you're posting that you've received cash for something you haven't earned yet. So you would post that. I can't speak for any other system, so this is now using Aplos examples, but in Aplos, what you'd do is you'd go to probably the register and post a deposit into the bank account that you've now deposited the money into, and you would have a liability account set up there that is unearned income or whatever. So you would record those two accounts. So this is going into my checking account using unearned income liability. And again, you're picking the fund. So now you're saying that is now my government grant fund. So now that you've posted that increased cash, it debited cash, it credited the liability in the fund that you were just selecting. So now if you go to your balance sheet, your overall fund balance wouldn't have moved because you've increased both asset and liability. So your kind of general fund balance wouldn't have moved. But if you run the balance sheet by fund, you'll now see that you have whatever amount that was in the asset for that fund. And then you also have unearned income for that fund as well. So then monthly, or as you earn it, depending on how you earn it, you would do a journal entry to decrease the liability and increase income for that fund. Again, that would now decrease that fund's liability and instead turn it into fund income, popping up on the income statement for whatever period. And then how can you custom tailor expense accounts for different funds rather than having a long linear list for the general account? Yeah, so this is we could do a whole hour on this too, is people look at me strange, but kind of the philosophy or kind of the ethos behind chart of accounts design. It's actually something that I kind of geek out on. I love it for some reason. But if you have let's just take office supplies. I always pick on office supplies. So let's say that you have office supplies as an expense account. If you're not using fund accounting, if you wanted to differentiate between the office supplies that you buy for general, grant, and outreach, you would have to, or you could, to capture that level of detail, set up either sub-accounts or different accounts using account grouping or some sort of hierarchy system, whatever. So you could have office supplies, general fund office supplies, grant fund office supplies, outreach fund office supplies. You just added two more accounts than you really need. So with fund accounting, or even with the level of detail that you can track using classes and tags, you can have one account, but then add the detail in there for whatever tag, class, or fund. So instead of having three accounts, you now have something like this guy. So office supplies, boom, there he is, 5301. So instead of having three office supplies expense accounts, I can have one. But again, because I'm picking the fund per transaction, it's now going to put it into the applicable column. So if I picked office supplies for my missions fund, that's going to go in that middle column there. If I picked general fund, it's on the left column. So that keeps up with kind of what bucket to put it into or come out of. And I don't have to necessarily increase my linear list of accounts. Now, there's benefits to doing that. Again, just kind of depending on how you need to report, you could capture all of the dimension and variability in the columns, and that might be all you need to do, and that might be fine. It's also possible that you might need to kind of group your accounts differently. So if you really needed to have like a separate, batch or group of expense accounts or even income accounts for that matter for a particular fund, you can still have both. Like you could still linearly, vertically build out your chart of accounts and have the column. It would just mean that instead of this. Say this 20,000 here, like this is just a part of fundraiser expense. It would just mean that there might be a building fund fundraiser expense down here, farther down the report, and now the 20,000 would be over here. So you can still build out both. Kind of just depends on how you need to go about it. But again, that's like a whole hour's worth of stuff that we can talk about, and that actually might even be more software specific than it is accounting specific, because with Aplos, we have account groups, we have accounts, sub accounts, funds, and tags. So you can, just the combination of all that stuff put together, you can you can build the same chart of accounts, 5 or 6 different ways and still get to largely the same reporting that you had with the other options. Just kind of depends on the org. So yeah, I don't know. Usually what I find is people build in the linear list more when they need to budget specifically for that thing. Because now if I only have one office supplies, but all 3 funds are touching it, then I would need to make sure that I'm budgeting by fund, and then I would need to run a fund budget report in order to see that value. Whereas if I just wanted one massive budget report that shows all things and all budgets, that would be more of a warrant for a long linear list, because you are wanting to kind of see it all side by side, if that makes sense. But again, that might be more of a software thing than it is an accounting thing. That was a very long-winded answer to that question. Hopefully that helped. And I don't see any other questions, and we have about a minute. So I'm just going to say that there are no other questions. But I'm happy to help with things after the fact. Again, what we're going to do here is send you a copy of the slide deck as well as the recording, technicality barring. And then we will also, sorry, let me go back to these requirements here. If you did the survey or the 4 out of the 5 poll questions and you were here for at least 50 minutes, which you're still here, so good on you. The last thing you'll need to do is complete the evaluation survey, which we will send here in just a little bit. So once you complete that, we'll send the CPE certification for you. And then if you have any other questions, feel free to just let us know. And if you want to contact me, you're welcome to. Otherwise, we can just respond as needed. So thank you for hanging out today. I hope the information was helpful. Again, if you have any questions, let us know, and we'll be sending you the evaluation survey here shortly for the CPE credit. Thanks, and have a good day.